And if you want to find out more about apexing and see our full risk disclaimer, go to apexinvesting.com. Obviously, trading in futures, options, swaps, anything has risk. Make sure you know what you're doing before you do it. And this is unique information presented by Apex. This is a very important disclaimer right here. It's just, again, very similar, but it's important because there is risk. You need to remember that when you trade. And futures, options, and swaps involve risk. They may not be suitable for every investor, may result in financial loss. Any decision you make is your responsibility. This is presented for informational purposes. The contents of this webinar is an offer solicitation to buy or sell any particular financial instrument. Past performance is not indicative of future results. Okay. And of course, that is important. I don't want you to just throw that off. I mean, remember when you're watching these things, any webinar, that there's always that risk and you want to check it out yourself. If you don't know, if you're brand new and you don't have a demo account, you can go over to nadex.com and then click on platform, and there's a little link right under there where you can get access. Let me show you where that is, and just in case you don't have one. Everybody should have a demo account. I have a demo account. Obviously, I have a live account as well. And as soon as you feel like you're ready and you have the funds to be able to put at risk, then you can move forward and make that step. But under trading platforms right there, you have the demo trading platform. You click on that and you can open a free demo account, and they don't expire anymore, which is awesome. So you can hop on and get that going. They have a iPhone app, they have an iPad app, they got Android apps, they got Windows apps. Obviously, you can trade on the web. And of course, if you have that, you can use the Apex scanner as well. Who is Apex? Apex is really just a community of traders. Our motto is real traders helping real traders. We don't just talk about what we do, we actually do it. I don't just talk about Nadex, I trade on Nadex. And we're a community. We're not a follow the guru company. We desire to help you be the guru, not follow the guru. We have a free membership available at our website, which has literally hundreds and hundreds and hundreds of videos, dozens of courses that you can take, and they're all free. All of our education is free. Step-by-step trading courses for binary spreads, futures, Forex, options, all sorts of things like that. We have strategies, which is how to use an instrument, systems, which are, how to help you decide when you might want to get in and get out of a trade. We have a free news calendar, which is very important on one of the topics we're talking about tonight, to let you know about, how news impacts markets and how far the expected move is. We have scanners that are free. Again, binary scanners for Nadex and spread scanners for Nadex that are free to use. So if I'm talking about them or showing screenshots, I'm not selling you something, okay? It's free. I made it for me to be able to trade, and I give it away. So make sure you check it out. It makes trading on Nadex a lot easier. We have deviation levels, which are expected moves based on what's called implied volatility, which is the most important factor in the pricing of a binary. So it might be good to be aware of what deviation levels are and implied volatility now. So just a lot of people taking advantage of the education and of the tools that we give away. And if you have any questions, you can hop on our live chat. You can hop on our forum. You can submit a help desk ticket. All those are, and I mean, even the most basic questions, we're there to help you. So take advantage of all these free resources, okay? Who am I? My name is Daryl Martin. I'm a lot of people call me the Nadex trading expert. I decided about 4 or 5 years ago that I wanted to really master Nadex because there was nothing, and I mean nothing out there at all to help traders and on Nadex, and I wanted to understand the instrument. So I set out to understand it. I wanted to master it. I wanted to build a profit on it. I've been able to do so, and I wanted to help other people learn how to trade on the Nadex platform. Even to the point where I made a scanner to help other people learn how to trade on the Nadex platform to make it easier. And even for myself to make it easier, because it does all the hard math for you. I've been a Nadex educational partner, which means they've asked me to help other traders learn how to trade as well. And I'm not an employee of Nadex, okay? So, I'm independent. I own Apex, and I am a trader. A lot of people wonder if, Apex is part of Nadex. No, we are not. We are completely independent. I have a background in commodities. Family, driving cattle, living on dairies, working out oil ranches, with oil wells, just all sorts of stuff like that. We worked on farms, so I've been around commodities all my life, and I've traded on exchanges all over the world: Australia, Singapore, India, Canada, Mexico, Germany, UK, not North Korea. I don't know where that typo came in. South Korea, U.S. and Japan, but. And let's say I have multiple books that I've contributed to, do a couple radio shows, and things of that sort. So, I've been around, I've traded a long time, I've traded all over the world. I know 70 option strategies, and I focus a lot on probability and risk management um, combined with discipline. And I like to look at how other traders look at the market. How do they look at it on fundamentals like news, on technicals, anything from volume to price action to order flow to moving averages to support and resistance. And I also like to look at seasonality as well and see whether it be the seasonality of the day, the week, the month, the year. Like markets react on things like payroll cycles that happen most often twice a month, and so most of the gains in the Dow happen on just a few days of the month when money goes, people get paid, their money goes into their 401k, that money goes into the mutual funds, which goes into stocks and drives the market up. So being aware of little things like that gives you an edge, helps you be ahead, have a better idea of maybe what to potentially expect for specific days or times of the day. And by understanding those different little things, you get a little bit further ahead. Like, should you expect more volatility in the morning when London is still open and the U.S. is opening up, or should you expect more volatility in the evening when Europe and the U.S. is closed? Which one should have more movement in the market? Simple question for you. Which one do you think will have more movement in the market? There we go. Okay, yes. The evening will have more movement in the market, not the morning, okay? And you want to wake up. So wake up right now for the webinar, okay? So a few people responded right there. I want to get y'all going, get your blood flowing, okay? That's probably one of the most important questions I can ask you about binaries is, when do you expect to be more movement? In the morning when the U.S. and Europe is open, or in the evening when the U.S. and Europe is closed? Where do you expect there to be more movement? In the morning or in the evening? So, of course, in the morning, there's more orders. Okay, so prices are going to be different on binaries. And we're going to talk about why. Okay, and why is there more movement during that time? And the number one reason is there's more orders, there's more traders, there's more volume. If you open up a chart and add volume to it, you'll quickly see how much more volume happens at different times of day, and that's where you should expect there to be movement, is where the volume occurs. Okay. One thing I highly recommend you hop on over to facebook.com/Apex Investing. All of our articles, webinars, everything we do is posted right there for you, so you can get access to it. The fastest way to get notification of any new tutorials or videos or webinars or anything that we put up. So again, facebook.com/Apex Investing. Once you like it, click on the like button and to say that you want to be notified of notifications, because otherwise you'll never see the notifications from a page you follow unless you say you want to see those notifications. So if you want to know, and we put out news articles and all sorts of stuff almost every day. So you'll get access to quite a bit if you follow us and say to choose all notifications there. All right, so on to tonight's topic. We're talking about Nadex binary Greeks, but I want to make them simple for you. Okay? I can put up some really complex things, but there's no reason to at all, period. All right? I'm going to do some really, really basic stuff pardon me, on binary options. And after that, we're just going to jump forward. If you don't understand, if it's too fast for you, if you hop on over to our site, we have binary courses that will take you from the most basic concepts to very advanced concepts. And you can take your time. They have quizzes. They have step-by-step. Today, we're going to talk about a little bit different topic. We're going to be going into Greeks, but I'm going to be translating those Greeks into English and help them be practical versus academic. Okay, and understanding them will help you pick the right binary, know why you're picking the right binary. But this is one of the biggest steps, and really all this comes down to is how they move. Okay, and why they move, why the price changes. Basics on a binary. So you have their value at expiration. A binary is 0 or 1. You've heard of binary code 0, 1, 0, 1, 0, 0, 0, 1, 1, 1, 0, 1. That's binary code. Okay, they're worth 0 or 100 in this case at expiration. If you buy a binary, you're assuming that either the underlying price will go up or expire above the strike. Is this essentially what you're saying? If you sell a binary, you're saying it won't be above the strike at expiration. You're thinking the price will go down or expire below the strike, at or below the strike. That at or below, by the way, is very important. It's not just below. Either the price is above the strike which means the buy trader would be profitable at expiration, or it's at or below. When I say it, I mean the underlying settlement price that they put together. The settlement price will be at or below the strike price. Again, this is understanding that you already get some basics of binaries. All the expiration times are always Eastern. You want to make a mistake on trading binaries? Have your charts be on your time zone, not Eastern time zone. That will cause you to make some mistakes, okay? One of the things that I've learned to do is I set the clock on my computer to Eastern time. I don't live in the Eastern time zone. I live in Central, okay? But I set my clock to Eastern, so all my news, all my charts, all my quotes, everything is all in the exact same time zone. It makes things a lot easier. Makes it easier for me to not make mistakes. Now understand, this is really important too. It's one of those things, a lot of people go, binaries are essentially a yes or no proposition. No, they are not, okay? They're much more than a yes or no proposition. Very rarely should you be holding a contract expiration. About the only time I hold a contract expiration is when I put in my take profit order, it hasn't got filled, and then during maybe a dark zone period where there's not a lot of quotes, then it goes up or whatever, I don't get filled, and then it goes to expiration, okay? Now, one of the things, and we'll talk about charts here in a second. Again, they're much more than a yes or no proposition. Please hear that. They are much more than a yes or no proposition. Binaries, I know on these bucket shops overseas that are not regulated by the CFTC, you basically have to hold them to expiration. That's not a good thing, okay? In the options world, very rarely do people buy, call, or put vanilla options, not the fake call or put designed name for the overseas things, but vanilla call or put options like on the CBOE and hold them to expiration. They buy them and they sell them. And very educated, famous traders have proven over and over again that they actually make more often if you don't buy and hold them to expiration. Okay? Now, I'm not talking about binaries, I'm talking about options in general. So if you are a trader that's buying and holding to expiration, you're probably not doing very well. Just saying, you're probably not doing very well. I'm going to talk about why here in a second, but you should be entering and setting a take profit for your trade, okay? And getting out of the trade. It's hard enough to be right about direction, much less right about time of price at a certain point, okay? Now, so that I'm just trying to put a few advanced concepts in your head. We can get in, let's get out. It's not just about expiration. At expiration, what happens? They take, on the indices, they take the 0 to last 25, so basically the last 25 fill prices. They drop the highest 5 fills, they drop the lowest 5 fills or trades, and they average the mid 15 and they round them out. Okay? So if there's 25 quotes, the highest 5 prices that the market was filled at, they drop them. The lowest 5 quotes, fills that came in, they drop them. The mid 15, they average, and that's the settlement. On Forex, they take the last 10 mid quotes, the average of the bid and offer. They drop the highest 3, the lowest 3, and they average the middle 4. Okay? That's how they determine that final settlement price. That's also how they determine that indicative price that you see when you're logged onto the Nadex platform, like inside the tickets or, you know, on the platform itself. And it's great to have that. It's a great reference point. But I need you to understand that price is not based on that indicative price. Only settlement is using that formula. When a binary price moves, it moves based on the underlying market. It moves based on pound dollar, not the last 10 mid quotes and the average mid 4 of pound dollar. It moves based on the ES futures, not the last 25 quotes of the US 500 indicative price averaging the middle 15. It moves based on the underlying market. For that reason alone, you should have an underlying chart. So Dave asked the question, what's the difference between the charts of Nadex and the underlying market? That difference is that settlement. The Nadex chart, the indicative chart, is just giving you an idea, because official settlement is not the chart. Official settlement, because I mean you have a delay between them sending data and the web receiving data and it showing up on your screen and all that fun stuff. But it's to give you an idea of what that indicative is going to be right at settlement. But while you're trading and it's open live and it's changing in price, they're basing that binary on the underlying market. Okay? So if you were trading and you were entering and exiting before expiration, should you be looking at an indicative chart or the actual underlying chart? What would be probably a little wiser? What do you think? The one that the price is based on, or the one that doesn't matter until expiration? Okay, sort of a self-fulfilling question. Hopefully you know the right answer would be it's wiser to look at an underlying chart. Plus, you can do more advanced features. Now, Nadex has awesome charts. They've improved their charting more and more and more and more, but it is still an indicative. Okay, it is not, meaning it is a calculated formula based on the underlying market. So it's close, but it's not exact, and it's going to be a little bit delayed because it's an average pricing. Okay, so I just want you to be aware of that. A lot of traders aren't. There's nothing wrong with it, and it's great, and I'm glad they have it, and I use it all the time in a pinch and stuff like that. But when I'm sitting down, I'm really trading hardcore, I'm looking at underlying market charts. Okay? Now, this is sort of like I did on the last webinar, I did a binary or spread Greeks made easy, and I went a lot more into options. So make sure you check that recorded webinar if you haven't seen it already. I think Nadex should have it up soon in their archive section, or get it over Apex. But it all boils down to this. Where's the underlying market, such as the dollar yen or pound dollar, gold, oil, S&P, whatever? Where is it in relation to the strike of the binary? Like it'll see will be greater than 159, 159.20, 159.40, right? In relation to expiration, so at what time does it expire? Okay, and to what upcoming news and movement is expected. So there's three things you need to really be aware of. Where is the underlying market in relation to the strike of the binary? Basically, where's the time right now in relation to expiration? Is it 5 minutes away, or is it 5 days away? And is there any upcoming news or movement expected in between now and expiration, such as on a Forex calendar? Okay? And then be aware of how binary prices react based on those various things, based on where the strike is in relation to the underlying market, in relation to expiration, how does the price move, and when there's upcoming news, how does the price move? So if you understand that, okay, you will have a better understanding of how binary prices move, and that will help you better choose the right trading strategy. If you understand how the price moves in relation to the binary strike, in relation to when it expires, and in relation to upcoming expected movements and news, you'll better understand how the binary price moves to help you better choose the right binary for the right strategy. Now, I can go into a lot of examples. Let me pull up a couple here that I know. See, John grabbed me these, so I'd have these available for you. 1 second, here we go. And what I want to do, that might be perfect. Let's see here, just 1 more second. I'm going to grab all of these and move them over here for you. That has the spread one, and I want to grab the binary one for you. Okay? And he grabbed all these for me so I could help basically explain how binary prices move. And what really helps is to look at what's called the price ladder. Okay? And it doesn't matter whether you're looking at the platform or a spreadsheet or the scanner or whatever. This is just a screenshot, okay? And more because I was just concerned about the market being closed. And, I guess it just now opened up. But you can look at the price difference if you'll train your eye to do this, okay? Right now on this, right here, we have the market at 1193, 1194, okay? And we can see that if the market, like right here, is 1193 strike, and it's at, what is the price on the strike? And we can see that if we bought this and the market moved up 3 ticks, we can actually move it up and we can sell it at 79.50. See, check this out. The 1193 strike, right there, the market's at 1194 on the indicative, but 1193 strike is priced at 65.75 to buy. If we just move down one, we can see it's at 79.50. And we have a little calculator that will do this for you, but just to show you, I want you to be able to just look at it without any tools or anything, just looking at it, 65.75. If the market moved up 3 strikes, then this one that's 3 strikes, lower, would actually be up here, and it'd be 79.50. So the market would move about, $15 in value. If the market moved, the opposite direction, if it moved down 3, then this would go from 65.75 down to 21.75. Now that's a contract with only 3 minutes, but I want you to look at how fast it moves 65 down to 21 or 65 up to 79 with only 3 minutes to expiration. And people go, oh, but the bid offer is so wide, it's $5, $8, $10. I'm like, it just moved 40 bucks or 30 bucks with 3 pips, okay? So you can look at the strike. Here's the lesson I want you to get. You can look at the strikes and you can go, if this, if I move this strike up 3, meaning the market moved up 3, what would I be able to sell it at? Or if I move this strike down 3, what would I be able to, sell it at? What would be my loss? What would be my profit? And you can use that to help you see how price changes. You can also look at expirations that cross over. So if we look down here, this one has 1 hour and 59 minutes, and this one has 5 hours. So basically this one has 2 hours and this one has 6 hours until expiration. And let's say we just look at the 1200 strike. Okay, 1.12, 1.12. Okay? And here's another 1.12. This one has 9 hours. And I'm trying to show you how simple this is before we make it hard. Okay? The 1.12 is priced at 20 bucks with 2 hours to expiration. The 1.12 is priced at $36.50 with 6 hours until expiration. And the 1.12 is priced at $43 with 10 hours to expiration. So that's not implied volatility changing. That's not price changing. That's just time. So do y'all see how time can impact a binary's price? That will expire greater than, if you're buying, greater than 1.1200. Cost 43 bucks, cost 36 bucks, cost 20 bucks. That's time and how it impacts the price. Does everybody see that? Is that simple? Could you look at multiple ladders now and you could actually see how time will impact the price? Okay? Does anybody not get that before I move on? Does anybody not get how looking at how this is 2 hours, 6 hours, and 10 hours to expiration, how the price is different on the exact same binary contract, 1.12? Everybody gets it? Okay, awesome. All right, so that's just time impacting the price. So where is it in relation to the strike? Okay, and that's what we were talking about earlier, how if it moved up or down. Where is it at in relation to time? Okay, so that's just showing that, hey, more time, there's more value in the binary contract, okay? And where is it in relation to news? Now, there wasn't really any major news right here that we have on the list, or we can look and see if there was, actually. Here's a simple little way. We're going to go over. These were taken on Thursday. So we're going to go back. Let's see, what do we have? We had G7 meetings. What preliminary GDP? I don't think that's the main one. Let's see here. Yeah, you have advanced, which is more powerful than preliminary. But, I mean, you had a little bit of news, but not a whole lot of news in there. So expected news didn't have a massive impact on the price. And we can even see if we can go down any further here. Yeah, 5, 9, 10, yeah, 10 hours, as far out as we go. So, but that gives you just a very good example of seeing how time and price can impact a binary option. Okay, so that's the simple way to look at it. All right, a few simple things I want you to get. There's 3 categories that there's really only 2, but we sort of make up the third one. There's out of the money, okay? So first of all, out of the money contracts are always going to have a risk of less than $50, okay? And out of the money is really simple. All it means is that the price has to move for you to make money. Okay, so if we look over here, this is US yen. It could be gold. It could be the S&P 500. It could be oil, whatever suits you. Okay, but this orange line is where the current market, at least was whenever I first had my data on. So I'm not turning it on. I'm trying to keep everything fast. But let's say the market over here is at 109, I don't know, 30 or whatever. And I buy a 109.50. If I buy it, I'm saying the market has to move. So I'm literally saying the market has to get from here and has to at least go up if I'm going to close early. Or if I'm going to, which I don't think is a good idea, if I'm going to hold expiration, or if I end up holding expiration, has to expire above that strike price. Okay? So you will notice that your profit will be higher, okay, and your risk will be lower on out-of-the-money contracts. We even label them on here, out-of-the-money OTM, in-the-money ITM. But notice how the risk is like $8, I could make 92. You know, it's $34. I could make 66. But it has to move. If it moves just a little bit, it can expire out of the money. Okay? If it moves in the wrong direction, you can lose. If it stays flat, you lose. Okay? It has to move in your direction, at least before expiration. It has to move enough, or it has to be greater than by the expiration for you to be able to be profitable. So your probability of profiting is lower on an out of the money contract. Okay? Now, is there more profit potential on a contract that expires in 10 hours than one that expires in 5 hours? No. They're all binaries have a maximum value of $100. You'll notice that if you add the profit and the loss together, in all cases, it's going to equal, you know, $100. This is like a bid offer in there, okay? But it's basically going to equal $100 if you actually put the two actual risk and rewards together. So, you know, 91 and 9, that type thing. But they'll always equal $100. So you can't make more. I mean, it could expire in 45 seconds and you could make $95. It could expire in 4 days and you could make $95. So you don't make more because you're in a contract longer. That's one of the reasons, honestly, I don't often personally trade the weeklies. It's very rarely I'll ever trade a weekly. Because I'm like, why take 5 days to what I can make in 5 minutes? You know? I mean, it just slows down your profit or it slows down your losses, I guess would be the other way to put it. You can go either way. But you don't make more. It just has more time to move. Now, it could also have more time to move against you. And it also moves slower. We're going to talk about that. The more time there is till expiration. So you don't actually make more money by it being, say, 5 hours out. Now, again, the risk is always less than $50, so your profit is always higher if you're buying an out-of-money contract because your probability is lower. Okay? An at-the-money contract is one that's right at the strike. Usually it will be priced between $45 and $55 with the bid-offer spread. So if, you know, again, this pink line being my strike, if my strike was right there where the annoying market was, then that base at the money, it doesn't really matter because remember, it can only be in the money or out of the money at expiration. But at the money just means that the market is right there. Okay, it's right where the strike is. So if the strike in this case was 109.23 and the market's at 109.23, then it's at the money. And it'll be priced, like I said, right around 45 to $55. Okay? Sometimes a little higher, sometimes a little lower, but pretty close. Now, why? This is important for you to get, and this will actually help you understand binaries. Does anybody have a guess as to why it's $50 when the market's right at the strike? Where's this random number 0 to 100? Where does it come from? What does that number mean? Why is it 50? Why is the binary, if I look at a binary and I find one that's right where the strike is, 1194, that's 195, so that's pretty close to 50, it's just above it. This one's just below it. Yeah, but why is it right at 50, okay, when the market is at the same price of the strike? Oscar, you get the gold star right there. There you go, awesome. It's a 50-50 chance that you're going to profit on the trade because it could go above or it could go below. It's 50-50 of where it's going to go. Therefore, here's a big concept for you, okay? A binary price is ultimately a probability, okay? A binary price is ultimately a probability of where that contract is going to expire. Okay, I'll say it again. That binary price is ultimately a probability of where the contract is going to expire. Okay, so that's why if the price is right at the strike, there's a 50-50 chance it will expire in the money. But if, like on some of our other examples, it is 34, then there's basically a 34% chance of expiring the money. If there's a 65, there's a 65% chance it'll expire in the money. Okay? Not touch, but expire. So we're going to come back to why it's so important to close, but that is a huge key to understanding binaries, is that the binary price at its heart is a probability of it expiring, not touching, but expiring in the money. In the money, risk is going to be greater than 50 bucks. Why? Why is the risk greater? Why is it greater than 50 if the market is already in the money, if it's already above the strike? Like this strike is 90 bucks. So 4 ticks in the money. It only has 3 minutes expiration. Because remember, that this is an example of the probability that the underlying market will expire greater than the contract. It's already almost 4 ticks in the money, 4 pips, whatever, in the money, meaning it can do nothing and it will be in the money. It can go up and it will be in the money. It could actually go down to 1190.1 and it would still be greater than 1190. It would be in the money. So it can move up, it can stay flat, it can even go against you, go down a little bit, and it can still be in the money. There's a higher probability. Okay? Now, if you give it 58 minutes instead of 3, you got 1191 right here, it's like 70%, because there's a whole nother 50-something minutes, 55 minutes or so, where it could go the other direction. Okay, it is in the money, so there's a 70% probability this contract, if bought, will expire in the money. Now, you're going to risk 70 to make 30 on the trade. Okay? But it's already above, the market's already above the strike. It doesn't have to move. You could be wrong. It could just stay flat. It could move up. Hey, that's even better. You could make your money even faster. It could go down a little bit, and you could still profit because it's in the money. Okay, same on the flip side on a short. 1187, it's already below 1193. There's an 80% probability it'll expire in the money below. Okay, sorry, I'm looking at that backwards. Let's go up here to 37. Let me reverse something because I said that backwards. On the in the money contract, okay, 3750. And then the reason I need to back this up is because it's actually the opposite. That's the chance it'll expire out of the money. So there's a 62.5% chance it'll expire in the money because it's already below the strike. 1195, the market's 1193. It's a couple ticks below. So there's over a 60% chance it'll stay below or go down or stay flat or even go up a little bit and still be in the money at expiration. Now, it may go above it and come back down. All sorts of things can happen, but this is what, it's an example of probability. Now, I want to do a fun little experiment with you, a very practical experiment. And this is going to show you why I'm always saying you don't want to hold the contract until expiration. Okay, let me zoom this in. It'll let me zoom it in. All right, so we're going to go over here, and if we make, okay, let's say we go in here and we make, let's say it's a $40 risk. Okay, so minus 40, minus 40. Now, if it's a $40 risk, what does that mean our probability is of expiring in the money? Who can tell me? On a buy, or even on a sell, whatever my risk is my probability. So what is my probability of expiring if it's a $40 risk? 40%. Okay? That it will expire in the money. So 60% of the time it won't. Right? So what I want you to see is if you bought a contract at the same price every time, your net profit should be 0. You shouldn't make anything. Okay, if the binaries are, correctly priced, which they're pretty spot on. Okay, I mean, if I go 30, so if I lose $30 70 times, or 7 times, 70 out of 100, whatever, and then I make 70, 70, 70, I make nothing. Okay, less bid offers and fees on top of that. So if you buy contracts and you hold them to expiration, If I lose, and if I go and I do $50 ones, okay? And again, this isn't accounting for bid offers. This isn't accounting for fees. I make nothing. Okay? And so after you pay commissions and all that, action could be a little bit greater. But the point I want you to get is, do you see why binaries being a representation of probability, holding them to expiration, probably isn't in your best interest? Because over the course of 10 trades or 100 trades, you should basically lose that exact of the probability and ideally profit the same amount of the probability. Doesn't mean you will, but that the theoretical price is based on probability. Okay? And if it's accurate, that means you aren't going to make anything if you hold it. But what if you went in, we got these minus 80s here, and then we make 20, 20, 20, 20, 20, 20, 20, 20. We make nothing. But what if we got out, and I'm not telling you what to do. I'm giving you an example to get you thinking. What if I got out when it went from 80 and it went down to 50? So I only lost $30, right? Just between 80 and 50. Now, and then let's say on these, let's say I only make 15. Because I get out when they make 15 versus holding the expiration to make all 20. Now I'm up $60 because I didn't hold to expiration. But if I would have held that same contract expiration, I would have lost 80 twice, would have made 28 times, I would have made nothing. I had a trader message me this weekend. They said, hey, can you help me out? I'm winning 90% of the time, but every time I lose, I get wiped out. It's because they lost 90 and they made 10 9 times. Okay? So learning to exit before expiration changes it where you're not playing the probability of expiring in the money. You're actually trading the binary, not betting on the binary. And you're going, hey, what can I do? Instead of buying and hoping or selling and hoping, you're actually trading the movement because you understand how the price moves. Is that an aha moment for anybody? That it's a probability-based contract, so if you hold it to expiration, you're probably going to make nothing over the course of X number of trades. So I hope a couple of you all go, that makes sense. So that means, all that means, that doesn't have to be anything difficult. It just means that you exit before expiration. Have a plan, okay? Now, another little side tidbit for you. All contracts are in the money, actually, and out of the money, right? Depending on if you're the buyer or the seller. So buying or selling does matter if it's in the money or out of the money. And there's what direction, what side you're on. I want you to notice right here on this screenshot. And again, I don't care if you use a scanner or not. It's your choice, but I want you to understand that how this helps you. In the money and out of the money. So in the money on the sell side, out of the money on the buy side. In the money on the buy side, out of the money on the sell side. In the money on the buy side, out of the money on the sell side. They're all in the money and out of the money. This depends upon what direction you're going. Because they're all going to expire in the money and out of the money, depending upon whether you're the buyer or the seller of the contract. Because either it's going to be greater than, or it's going to be less than or at, that are like the indicative price there, at expiration, be the same as the strike. Or above the strike or below the strike. So it's either going to be in the money or out of the money. At the money, like I said, is just something we made up to say, to identify in verbal or written communication that the market is at the strike price. But at the end, it's either in the money or out of the money. Okay, again, it all boils down to where is the underlying market in relation to the strike of the binary, in relation to the expiration, and to what upcoming news and movement is expected. How does the binary price react at those various points? And this allows you to understand how it will move and what's the best one to use. Now, again, there's a lot of ways to explain price movement. Greeks are a fancy way to say a math formula to measure price movement. Greeks do not, I've heard it stated that Greeks move the binaries. No, they don't. Greeks do not have any impact on the binaries. They are a measurement of the binaries, okay? I've taught on these quite a bit, not necessarily just as a major focus except for on radio shows, but I mean, they're one-day options or they're 5-day options. They don't have to be complex. You don't have to be a rocket scientist, okay? The word Greeks is an academic thing. Doesn't help you a whole lot, especially on these sort of a contract. Now, there's 5 common Greeks. Let's talk about what those are. There's Vega. We talked about this on the spread webinar in a lot more detail, but Vega, which measures how much the option will change in a 1% change in implied volatility. Applied volatility, by the way, is a fancy word for expected movement in the market. Okay. Theta, which measures time, how much the option price will change with how much time decays. There's delta, which is how much since the price of the option will change the $1 move in the underlying. And there's gamma, which is how much the delta will change with the $1 move in the underlying. And there's rho, which is how much the price of the option will change with the interest rate changing. Okay? So, rho we don't really care about, has little to no impact. Now, side question that came up, I'm going to go ahead and answer it real quick. It's out of order, but it is, what about spreads? Should you not hold them to expiration? Well, spreads are not an all or nothing proposition at expiration. So it's not as big of a deal to have them to expiration. Binaries are an all or nothing. Spreads are not a probability-based instrument like binaries are. Binaries are a statistical instrument. So that it doesn't apply the same to a spread as it does to a binary. There are many times I will hold a spread to expiration. Okay, another thing for you. If you want to get real complicated on this, there's a lot more than 5 Greeks. There's not only delta, gamma, theta, vega, rho, there's also vana, charm, veda, vera, color, speed, ultima, zama, duo, delta, duo, gamma, fusion, and there's a whole lot more than that. Okay? So this can get as complex as you want it to. It doesn't mean you're going to make more money. Okay? So again, we want to turn these Greeks into English. It's just a way to explain movement. It's a fancy math formula. Okay? They have zero impact on the price movement. They just help you understand how it moves. Medical calculation. Okay? On most of the Greeks, because, I mean, to price a one-day contract is very difficult. Okay? For most people to do that. So just to understand how they work, it doesn't really matter. It's just a short-term expiration option. Now, let's get into the Greeks. Okay, and rho has no impact, but delta is a big one I want to talk about for a second. Okay? There is no delta in a binary option. Okay? Delta, again, is how much a binary changes in the 1-point move of an underlying market. Why is there no delta of a binary? Because a binary is delta. Literally. Okay? A binary is a delta. Does anybody understand that? A binary is the delta. Okay? And I want to prove it to you. Okay, I mean, we already talked about how it's the probability. We talked about a lot of things. But all a binary option is the delta of an underlying market. Now, the problem is, let's see, well, it's Monday. We might have them. Let me see, 1 second. Let me find the S&P. Let's find weekly contracts. They don't open until 3 a.m. Right, show it to you. Okay. What I was going to show you, I'll sort of show you what I was going to show you, but I can't because it's not open right now. It's right over here. If we went and we looked at the bid or offer, the average of the bid and offer, against the delta on an S&P E-mini future that had the same strike. So if I went in here and I found like we're going to have 2090.5 was a 2100. We have 2100. What close to that? 2090, 29.5 and 2090. Okay, if you look at the price of the 2090, the delta, that's like 61 on the call side. If that market opened up where the market is right now, then that binary is going to cost $61 at the mean, at the bid offer average. Okay, a delta and a binary are the same thing. A binary is the delta of a call option. Does that matter to you? Not really that much, but that's what it is. It is literally, you're trading a Greek when you're trading a binary. A binary is the delta of a call option with the same expiration, the same strike. So you got to look at Friday expiration. So weekly expirations on Nadex. Look at S&P E-mini. Okay, contracts. Look at their options. Look at their delta. You're going to see that within a few dollars, I mean, with bid offer, all that, they're going to be right at the same. They are the delta. Okay? Now, if we go in and understand their probability, now, have y'all ever seen where you'll get the same price over and over and over and over again. Like it goes up and all of a sudden you get $7, $7, $7, $7, $7. Have y'all seen that before? Okay, when that happens, when there's like $7 offers or $93 bids all the way down, obviously that percent probability doesn't work anymore. It's that very first one, because I mean obviously it's not 7% for a higher strike and a higher strike and a higher strike and a higher strike that it's going to expire in the money. So it only works to the point where there is a bid and offer both quoted. Okay? Again, it's not about touching, it's about expiring there. So don't hold it to expiration, or if you do, just to understand what you're doing. Okay? Not so much telling you what to do, but those holding to expiration on purpose, they're not so much trading as they're buying and selling, hoping when the odds really are against them on the probabilities that they'll at best break even. Okay, so that is our delta. We also have vega. Vega is not a Greek letter. It's the amount the value of the option will change for a 1 point change in implied volatility. It's the most powerful Greek. It actually impacts options that are further from expiration and closer to the strike. Okay? It's highest right before things like earnings announcements or interest rate announcements, things like that. It'll make the binary very expensive. And a couple tips for you. Like I said, it's not just the most powerful Greek, but it will override everything. It'll actually cause what's called a volatility crush at times right after a news announcement. Okay? So understand that. Implied volatility is, and if you have questions that are not related to what I'm talking about, I'll try to talk to you after the webinar is over. Okay? But let me focus on what we're on right now. So it's the amount of the value of the option that will change for a 1 point change in IV. IV is expected movement. If interest rates coming out, do you think that there's going to be more expected movement? If the FOMC is about to announce a potential change in the interest rate, do you think that there's more expected movement in the market? Yes or no? I mean, really simple, but yes or no. Do y'all think that the market's going to move more than it did 5 minutes ago if an FOMC is about to announce an interest rate change? Yes. Okay, thank you. Yes. So Vega will actually override it. You'll see options not even seem to change in price at all because they expire after a news announcement and the price isn't going to change. Why don't they change much? Well, what you're going to notice is that increased implied volatility will move the price closer to 50. Okay, so again, I'm going to say that again. Increased implied volatility will move the price closer to the center, closer to 50. So you'll see like 50, 55, 58, 60, 64, 69, 73. And you're like, man, I can't get an out of the money or even in the money that's that far away for much of it. Because, I mean, it's just everything's so close to 50. Now, on the flip side, when there's not any implied volatility, okay, then you'll see it go from like 50 to 10 to 90. But when there is, I mean, it'll be like 50, 55, 60, 65, 70, 75, you don't see that big change in price. So the price moves much slower and the price is much closer to 50. The reason this is so important is if you decide to tackle binary options, okay, I often say that I like spreads. I traded spreads for 9 months before I touched a binary because spreads are a lot easier to trade. They're a little harder to understand, but they're a lot easier to trade. But you have to be able to grasp this because you have to know when to change up your binary strategy. Because sometimes the price only moves $10 in a 3-tick move, and other times it moves $40 in a 3-tick move, depending upon what the implied volatility is at. How can you tell that? Where do you get that IV reading? It doesn't really matter what the IV reading is. Just look at the price ladder. How close are they? How close are the contracts? When you go from one strike to another strike to another strike to another strike, if the prices are really close, the IV is a lot higher because there's more expected movement. Either there's a lot more time till expiration or there's a big news announcement about to come out. And they're going to move slower on you. But you also need to look at the price ladder if there's a big gap in the prices between one strike and another, because that means there's not a lot of implied volatility. But the price will change dramatically fast, and it creates a whole different opportunity where you can go in for a few ticks and you could make, twice your risk on the trade on just a few ticks. But other times you only make $10 and you risk 60, okay, on the same. So when you go in and you look at it, make sure you look at those strikes and look at the price changes on them. And I'll bring over an example for you again from some of the examples I had up over here. And you can sort of see it a little bit more with more time. you'll notice how there's a bigger gap, 34, 65, 90. Okay, we have like $30 differences here. But if we go down here a little further, you'll see 29, 47, 68, 85, 90. See how there's, I mean, it's not as dramatic of a change in price. So you got a little bit more, you got a little less difference in prices with more time because there's more implied volatility because there's more expected movement. IV impacts contracts with more time until expiration or with the news that is coming out and about to happen. To visually show you what I mean, this is a stock you may have heard of called Apple, okay? And if you look at Apple, like this is when the earnings are coming out, okay? Earnings are expected. They're announced. They say, we will release earnings at this time on this day, okay? And so if you look at it, you can see how this is the implied volatility. The implied volatility goes up. The announcement comes out. The implied, even though the price moved a lot, there was a lot of volatility. I've heard somebody say, well, implied volatility is a measure of expected volatility and historical volatility. And historical volatility does impact the price of the option, but not near as much as implied volatility. Because look at how it dropped after there was massive volatility on this stock, okay? I mean, it went from 190 down to like 130, I'm sorry, down to 120, $10 move, 10% move. Implied volatility just dropped, okay? It rose up again right before this one, and then it dropped. It barely even moved on this one. Rose up and then dropped massively. That means the options got cheaper. They got more expensive going into the earnings announcement, and they dropped right after the news or earnings announcement. It's called an IV crush. So you'll see right before FOMC, ones that expire like at 2 o'clock will be pretty cheap. Ones that expire, say, at 3 o'clock or 4:15 will be very expensive because they have that implied volatility of that big news announcement coming up. Let's see. We talked about it means implied volatility. The higher it is, the more premium. The less it is, the less premium. It pushes everything to the center. Overrules theta, delta, gamma, vega, all that stuff, more important than anything. It has less impact closer to expiration. That's vega, okay? What about theta? Theta is not as big of a factor in binaries as people want to say it is. You know, when we talk about collecting time value, collecting premium, we're really collecting volatility. Because how much air goes into that tire is the theta, but that tire pressure is the implied volatility. Okay? So how much expected movement is there? And then that will put more time value, more theta in there. So you'll see it, you know, how the price changes, and it'll move, you know, move time slower. The more time, the slower it will change. So a 1 week binary will move much slower. Just look at the price ladder and see how the price changes between strikes compared to one that's a day away, 5 hours away, 2 hours away, 5 minutes away. You'll see how much faster it changes. So again, theta is more about implied volatility on a binary than it is about theta, because remember, you're trading delta. You're actually trading the delta of a call option. Keep this really simple. It's a 1 day contract, okay, maybe a 5 day contract, but it's a delta. It's not an actual call, vanilla call or vanilla put. It changes over time, okay? It moves faster as it gets closer to expiration, but it still can rise if implied volatility increases. So we talked about that. Gamma. Now, gamma you do have. Gamma is the delta of a delta, so that's sort of your delta on a binary. If you want to say there is a delta, gamma is it. Gamma is how much the delta changes over a 1 point move in the underlying. So on a binary, you could say gamma is how much the binary changes over a 1 point move in the underlying, because the binary is a delta. Okay? The less theta there is, the more gamma you get. The less time till expiration, the more gamma you get. The less implied volatility, the more gamma you get, meaning the faster it moves. So it says faster delta gets to full speed. Well, in this case, the faster the binary gets to 0 or 100, because the binary is a delta. All right? Gamma, again, can be overridden by implied volatility. So all you have to do is learn to look at, if you will just learn to look, and again, when we have a calculator, you can put in price and stuff like that on the scanner, but it doesn't matter. You can look at anything you want to that gives you the pricing, and all you do is look at it and see how does the price change on the strike ladder. Okay? Or how does it change over different expirations on the exact same strike, 47.75 versus 46.75. Wow, that's a whole hour, and there's a $1 difference in movement. There's probably something happening right there, because there's a $1 difference in price. 47.75, 46.75, 37.50, 38.75. Literally, it's $1 more expensive on one side, okay, with one more hour. So if I'm going to choose, I may choose that one. But here's the trick. Now let's look at what happens when it moves. It moves a few ticks, and that one's 29, that one's 25. That one's, 47, that one's 68, 46, 70. So I actually make more and lose more with less timed expiration. I make more and lose less with more timed expiration. Or I make less and lose less with more timed expiration. And you can see that if you'll just learn to slow your mind down for a second and just look at the strike ladder on the binary contracts, you'll see how delta, gamma, theta, vega all work, but you don't need those words, okay? And that's why I often say the Greeks don't matter in the sense of you don't need the Greek numbers. You can just pay attention to the strike ladder. The Greeks just is a way for us to explain price movement, okay? It gives a word to it, okay? To me, it's just look at the strike ladder, look at how the price moves. Translating that Greek into English. So it all boils down to where is the underlying market in relation to the strike of the binary, in relation to the expiration, and in relation to any upcoming news and movement expected. How does the binary relate at those points? Once you understand how the binary moves, you can best choose the best strategy, best binary for your strategy. All right, first thing is to grab a demo account, okay? And hop over to Apex, hop over to Nadex to get your demo account, and then a live account, and then hop over to Apex Investing, where you can get free education. You can get more basics, more practical application, more strategy systems, things like that. All the education is free over at apexinvesting.com. Just sign in as a free member. Look under free tools and education, okay, once you sign in. The deviation levels, the scanners will help you out. Check all that out. And then, of course, ask us questions. And don't forget, again, follow us on Facebook at facebook.com/Apex Investing, and make sure to click on the like link and choose notify you of all posts so you find out about articles and things like that we have. Looks like I got pretty much everybody's questions, and I want to thank you for coming on today. And I look forward to helping you in any way I can in your trading endeavors. Thank you again. All right, so that wrapped up the recording. Let me see if there is any other questions.